There is a pattern in economic history that repeats with unnerving precision. It does not strike every decade, nor does it arrive randomly. It appears when a specific cocktail of conditions aligns: extreme valuations across asset classes, unprecedented debt burdens, leverage spread throughout the economy, and a popular conviction that this time is different. Add a trigger that forces liquidation, and the cycle begins. These conditions existed in 1929. They appeared again in 2008. And in 2025, every one of these conditions is not just present, it is amplified. The stage is set, the dominoes are lined up, and the outcome will follow a familiar script if history is any guide. Crashes are not prophecies. They are not supernatural events delivered by chance. They are consequences that emerge from structural imbalances. You can read the past and understand the future because the logic never changes. Debt accumulates, leverage expands, optimism becomes delusion, and then someone somewhere pulls the first thread. When it unravels, it tears through balance sheets, markets, institutions, and entire societies. To understand how this unfolds, you need to know who loses everything, who profits beyond imagination, and why the coming downturn could rival or even surpass the Great Depression and the global financial crisis combined. The reasons are simple. Our scale is larger. Our financial system is more interconnected, and the tools used to fight past crises have already been exhausted. Every crash begins with a bubble, and ours is the largest everything bubble ever recorded. It is not limited to equities. Real estate in global cities sits at record highs. The median home costs roughly $420,000 against a median household income of $75,000, a ratio of about 5.61. Historically, stable markets hover around 3:1. Anything above that means housing is decoupled from incomes. In 2006, at the height of the housing bubble, the ratio reached 5.0. Today, we are far beyond it. Corporate debt is also swollen. Non-financial corporate liabilities exceed $13 trillion and sit at more than 70% of GDP. In 2007, right before the crash, that figure was barely above 40%. Today, corporations borrow aggressively to buy back shares, inflate earnings per share, and survive in an environment where equity growth is mandatory. Worse, many firms have little intention of repaying principal. They just refinance endlessly until the credit window slams shut. Government debt sits above $36 trillion, over 120% of GDP, a burden once reserved for wartime economies. Interest payments alone are approaching levels that rival defense spending. Add another $17 trillion of consumer obligations, credit cards, auto loans, student debt, and the total debt load surpasses $90 trillion. When an economy's liabilities exceed 3 times its productive output, it becomes fragile. Every sector, every household, every institution is extended. How did we reach this point? For 15 years, the Federal Reserve conditioned the market to believe risk is a myth. After 2009, every time the stock market sneezed, the Fed delivered liquidity rate cuts, emergency lending, quantitative easing. QE1 became QE2. then QE3, then pandemic stimulus. Between 2008 and 2022, more than $8 trillion in newly created money flowed into asset markets. Investors internalized a dangerous rule: buy the dip. The Fed is your safety net. This was not a conspiracy. It was Pavlovian conditioning at scale. There is one critical flaw. The central bank has spent its ammunition. Interest rates lived at zero for years. There is no room to descend further without deepening inflation. The Fed's balance sheet ballooned from $800 billion to $9 trillion, an expansion that would have been unimaginable in earlier decades. When inflation finally arrived in 2021-2022, it was violent. The Fed responded with the fastest tightening in 40 years, lifting rates from near zero to above 5.5% in less than 2 years. The result? Debt accumulated under cheap borrowing is now suffocating under expensive refinancing. Mortgages issued at 3% must be refinanced at 7%. Corporate bonds issued at 2 to 4% mature into an environment of 6 to 8%. The math is brutal. If the Fed lowers rates, inflation reignites. If it holds them high, defaults accelerate. There is no painless path. There is only a choice between slow bleeding or sudden breakage. This dynamic is not new. In 1929, U.S. equity indices surged by more than 400% over 5 years. Margin debt had ballooned to 10% of GDP. Economists famously declared a permanently high plateau. It took only a few weeks for that illusion to collapse. The stock market lost 89% of its value over 3 years. Wealth evaporated, and the crash metastasized into a decade-long depression. In 2008, the bubble migrated to housing. Property prices doubled from 2000 to 2006. Mortgage debt reached parity with GDP. Banks invented products to lend to people who could never afford repayment. Everyone knew housing prices never fall nationally until they did. Subprime defaults cascaded into the financial system. Lehman fell. Liquidity froze, and equities plunged more than 50%. That crisis was not an accident. It was delayed accountability. The 2026-2027 crash will follow the same formula. The variables evolve, but the mechanism remains. We have the asset bubble. We have the leverage. We have the belief that central banks can prevent collapse. All we lack is the trigger. The most visible trigger is commercial real estate. Remote and hybrid work, permanently reduced demand for office space. Vacancies in major cities run near half of total capacity. Buildings financed at cheap rates now confront refinancing at double or triple the cost. A tower that survived at 3% interest becomes insolvent at 7%. Owners walk away, not because they are insolvent, but because it is rational. In 2023, Brookfield defaulted on 2 Los Angeles office properties, not due to bankruptcy, but because lenders were better off holding depreciated assets than Brookfield was paying to preserve them. More than $2 trillion in commercial real estate loans mature between 2025 and 2027. If even a fraction default, regional banks will be crippled. Many hold 20 to 40% of their loan books in this sector. The public saw Silicon Valley, bank, Signature, and First Republic collapse in 2023. Most people blamed interest rate mismanagement. Few recognized the deeper fault line. The value of collateral itself has vanished. A second trigger lies in corporate or sovereign defaults. Companies gorged on cheap debt during the pandemic era. Today, they face refinancing cliffs. Even profitable firms find themselves strangled by higher yields. The weakest will fall first: retailers, commercial landlords, zombie companies whose existence depended on perpetual funding. But the real threat emerges when a giant fails. Lehman was not the largest bank in 2008. It was simply the one that broke the illusion of stability. The instant confidence shattered. Credit turned to ash. A third trigger could come from geopolitics or supply chain shocks. Modern finance is wired across continents. The failure of a European bank strands American pension funds. A war in East Asia disables semiconductor production and freezes global tech supply. A debt crisis in South America destabilizes commodity markets. We live inside a network so interconnected that no single node can collapse quietly. When the trigger hits, the sequence is predictable. Margin calls. Force sales. Sales drive prices down. Prices falling. Destroy collateral value. Banks tighten. Lending. Companies slash jobs. Governments panic. Politicians blame speculators, foreign actors, and unforeseen circumstances. But nothing will be unforeseen. The seeds were planted years earlier. Every crash is a redistribution event. Paper wealth dissolves, but real assets persist. Land, productive companies, intellectual property, energy infrastructure. Those who hold too much debt lose everything. Those who hold liquid capital buy the ruins. This is not cynical. It is arithmetic. Crises do not reward morality. They reward preparedness. The coming crisis will not mark the end of capitalism. It will mark the end of one cycle of excess. The stronger hands will replace the weaker ones. It has happened before. It will happen again. The only question is who will stand on which side of the liquidation. When corporations refinance at interest rates 2 or 3 times higher than what they enjoyed before, something breaks. Not gradually, but suddenly. Many firms simply cannot afford to roll their debt. Their balance sheets were built on perpetual borrowing, not repayment. If a major company, a Fortune 500 industrial giant, or a global technology firm defaults on its bonds, the shock is immediate. Bondholders panic. They assume the default is not a one-off mistake, but the first crack in a much larger wall. They dump other high-yield bonds, then investment-grade bonds, and eventually anything that looks remotely risky. Yields surge. Financing disappears. Firms that were stable on paper collapse because credit is oxygen, and the market has just shut off the air supply. This is how 2008 unfolded. Lehman Brothers did not bring down the global economy by itself. It simply punctured the illusion that everything was fine. Once Lehman failed, investors assumed others would follow. They were right. Credit markets froze. Not because every institution was insolvent, but because no one trusted anyone else's books. Contagion is never about numbers. It is about confidence. The moment confidence breaks, the the machinery of modern finance grinds to a halt. Sovereign debt creates a similar but even larger hazard. Imagine a major emerging market, Turkey, Argentina, Pakistan, defaulting on dollar-denominated bonds. The default does not just hurt those bondholders. It prompts investors to reevaluate every country with similar vulnerabilities. If one nation breaks, others might be next. Funds flee to safety. US. Treasuries, gold, cash, emerging currencies collapse under the weight of capital flight. Local banks fail because their assets are denominated in dollars they can no longer access. Governments impose capital controls, but by then, the damage is irreversible. Every default is a message. The mathematical promises of yesterday cannot be fulfilled today. The deeper problem is that emerging economies hold trillions in external debt, much of it priced in dollars. When the dollar strengthens, or when global interest rates rise, they suffocate. They must pay back in a currency they do not print. European and American banks financed large portions of this debt. If defaults cascade, the losses hit developed markets. Contagion spreads outward, not inward. The epicenter is never the only casualty. A third possible trigger is geopolitical shock. War, a terrorist attack, a viral outbreak, or a political crisis. These shocks do not need to start in the financial sector. They simply need to inject uncertainty into the system. When people cannot predict what tomorrow looks like, they sell today. The COVID crash of 2020 was not financial in origin. It began as a health crisis. But globalization ensured its effects were instant. Investors rushed to cash, dumping equities, bonds, and commodities. Within weeks, markets fell more than 30%, and trillions in value vanished. Any similar shock could spark the next cascade. A war in the Taiwan Strait disrupting semiconductor supply chains. Escalation in the Middle East threatening oil transit. A contested U.S. election that spills into street-level unrest. The specifics matter less than the psychology. When uncertainty rises sharply, spreadsheets become irrelevant, and human instincts take over. Protect capital. Sell risk. Hold cash. Liquidation becomes reflexive. Whether the trigger is real estate, corporate defaults, sovereign debt, or geopolitics, the initiating spark is incidental. The underlying cause is the same. Valuations stretched beyond reason. Debt piled on debt. And a financial culture taught to ignore risk because rescue always arrived. Once liquidation begins, the mechanics of collapse take control. They are brutally consistent. Phase 1 is the initial shock. Something breaks. Markets fall 10–15% in days. Investors are stunned, but not terrified. They interpret the decline as an opportunity. Buy the dip, they say. After all, that strategy worked for 15 years. Analysts appear on financial news networks to reassure the public. They point to strong fundamentals, resilient consumer spending, stable corporate earnings. The downturn is temporary. Confidence flickers, but does not die. Historical precedents reinforce this behavior. In 1929, the first major drop, Black Thursday, sent the market down 11%. Panic erupted, but elites intervened. Bankers met, pledged capital, and stocks rebounded. The public breathed a sigh of relief. The worst appeared behind them. In 2008, Bear Stearns collapsed. The Fed engineered a rescue through J.P. Morgan. Investors believed the crisis was contained. They were wrong both times. In the modern context, the first shock might come from a bank failure or a wave of corporate bankruptcies. The Federal Reserve will issue statements about liquidity and stability. Politicians will appear confident on television. Investors will seize the dip. And for a moment, markets will recover. The crack will be visible, but not yet terminal. Phase 2 is the false recovery. This is the most dangerous stage. Markets stabilize or rise slightly. It can last weeks or even months. Optimism returns, not because conditions improved, but because humans want normalcy. We prefer the world. We understand to the world we fear. The pattern is timeless. After the 1929 shock, stocks rallied for days. Newspapers praised the courage of buyers. Investors who had panicked early felt foolish. Then November 11th arrived, and the market plunged more than 13% in a single session. The real collapse had merely been delayed. The same psychological trap emerged in 2008. After Bear Stearns, the S&P drifted sideways for months. Economists wrote essays explaining why subprime losses were limited, why banks had stabilized, why household wealth was intact. By July 2008, the market was down less than 10% from its peak. The crisis was supposedly over. Then September came. Lehman imploded, and the world lost half its equity value in 6 weeks. In a future crash, the false recovery might last 3 to 6 months. People will blame the first failure. Perhaps a bank, perhaps a real estate conglomerate, on mismanagement. It does not reflect the broader economy, they will say. The Fed may cut rates modestly. Stocks rally. Hope returns. Meanwhile, beneath the surface, stress accumulates. Refinancing deadlines approach. Collateral erodes. Loans quietly sour. The system decays. Then comes phase 3. The cascade. This is not a market decline. It is a structural failure. Forced selling. Drives. Forced selling. Margin calls wipe out leveraged investors. A 20% market drop can destroy those trading on 50% margin. Brokers demand more collateral. Traders cannot provide it. Assets are sold automatically. The sale drives prices lower, triggering more margin calls, more liquidations. Everyone is selling. No one is buying. Institutional investors then buckle. Pension funds, endowments, mutual funds face redemption requests. Clients demand cash. To meet withdrawals, funds liquidate holdings at fire sale prices. Hedge funds unwind positions they carefully built over years. Quantitative strategies malfunction because the volatility assumptions they rely on no longer apply. Stop loss orders multiply losses. Circuit breakers pause trading. Each pause intensifies fear. Liquidity evaporates. Markets do not move gradually. They gap downward. A stock worth $80 might open at $62 the next morning. No incremental decline. Just vacuum. Bonds behave the same. Bid-ask spreads widen. Corporate financing halts. Debt that was easily refinanced 6 months ago becomes toxic. Next, credit markets freeze. Banks will not lend when borrowers might fail tomorrow. Firms that need liquidity cannot access it. They default. Their lenders take losses. Asset write-downs spread through bank balance sheets. Rating agencies downgrade debt. The spiral tightens. During this phase, the real economy buckles. Stock market collapses. Wipe out household wealth. Consumers feel poorer. They stop spending. Revenue at corporations shrinks. Layoffs follow. Unemployment spikes from 4% to 8 to 10% within months. Jobless workers reduce spending further. More businesses fail. Small banks collapse. Confidence dies. The downturn becomes a depression in everything but name. Phase 4 is maximum panic. Capitulation. Everyone sells. No one asks for price, only exit. This is where bear markets complete their work. In 1932, the Dow sat at 41 points, down almost 90%. Bread lines stretched across cities. Banks dissolved. In 2009, the S&P hit 666. Unemployment peaked, and governments nationalized financial institutions to prevent total collapse. A future panic could arrive in 2027 or 2028. The numbers may change. The trigger may differ. But the psychology will not. Only when fear reaches its apex, when the market feels hopeless, will the seeds of recovery be planted. Phase 5 begins with intervention. Governments do not reform calmly. They reform under duress. Roosevelt rebuilt the financial system after 1933. In 2009, global authorities injected capital, guarantees, and extraordinary stimulus to prevent systemic annihilation. Recovery does not start because investors feel optimistic. It begins because the state rewrites the rules. The recovery from the 1929 crash did not happen in months or even a few years. It took the better part of a decade before the financial system began to stabilize, and the stock market would not return to its 1929 peak until 1954. 25 years later, people imagine that markets bounce back, but history shows they crawl back, dragged upward by external circumstances. The rebound of the 1930s was not organic. It was engineered by war-driven industrial mobilization, government programs, and massive public spending that essentially rewired the economy. The system did not heal because investors regained confidence. It healed because the state changed the rules of the game. By contrast, the 2008 crisis delivered a faster rebound. Governments bailed out banks. The Federal Reserve flooded the system with liquidity. And Congress injected stimulus into households and corporations. It was the modern era of controlled collapse. If the private sector failed, the central bank printed. Stocks reached new highs by 2013, and the broader economy recovered by around 2015. The price of that recovery was not visible immediately. It came later in the form of dependency. A financial architecture was created where every downturn must be treated with more stimulus, more intervention, and more debt than the last. The system's metabolism changed. It became addicted to assistance. The next crash will arrive in that altered environment. interest rates will fall back to zero or near zero. The central bank will not expand its balance sheet modestly. It will do so on a scale meant to shock. Congress will pass multi-trillion-dollar relief packages that dwarf the programs of the past. Banks that become insolvent will be rescued, not because they deserve to survive, but because letting them fail would ignite a chain reaction. Yet the recovery will not mirror 2008. It cannot. The economy will not begin from a base of moderate leverage, but from the highest debt levels in modern history. National debt already exceeds 120% of GDP. Add stimulus and crisis support, and the ratio can climb into the 150% to 180% range. At those levels, debt service ceases to be an accounting nuisance and becomes the central fact of public finance. Tax revenue is devoured not by investments in infrastructure or schools or technological growth, but by interest payments owed to bondholders. The government finds itself trapped between choices that are all painful: austerity that depresses growth, higher taxes that suffocate the productive class, or inflation that erodes the value of savings and wages. None of these options are politically sustainable, yet the system must choose one of them. And when it does, recovery slows. Markets may rebound, but society does not heal at the same pace. Ordinary households cannot wait out the downturn the way a hedge fund or sovereign wealth fund can. Every great crash erases the wealth of the same group, the middle class. In 1929, the families who believed the stock market was a ladder into prosperity lost everything. Paper gains built over a decade evaporated in months. Homes were foreclosed when incomes collapsed, and banks refused to negotiate. In 2008, homeowners who bought at the peak saw 40 to 50% of their equity vanish. Many walked away from mortgages that no longer made sense. Others were dragged through bankruptcy. A new downturn follows the same script: families with retirement accounts, people who dutifully contributed to 401ks, because that is what the financial industry told them to do. See their balances collapse by half or more. A $500,000 nest egg becomes $200,000. Those who bought real estate during inflated valuations witness property values fall 30 to 50%. A $600,000 home becomes a $380,000 liability with a fixed monthly payment. Retirees suffer most, not because they are reckless, but because they lack time. They cannot wait 8 or 10 years for markets to recover. Their assets fall while their expenses climb. Bonds lose value when interest rates shift, and fixed income loses purchasing power against rising prices. Small business owners rarely survive the cascade. When consumers stop spending, revenue evaporates. Rent, payroll, inventory, and utilities remain. Businesses close, not because they were incompetent, but because demand vanished. In 2008, more than 170,000 small firms disappeared. In the next downturn, with higher rents, higher labor costs, and more corporate competition, that number could be far worse. Restaurants, salons, contractors, clinics, family retail stores, all exposed to the same shrinking cash flow and the same unsympathetic banks. Those who borrowed to invest are wiped out in the most violent way. Margin traders face forced liquidation at the absolute worst prices. Real estate investors, who leveraged debt to expand portfolios, confront collapsing rents, falling valuations, and lenders who want their money back. Losses exceed the original investment because liabilities remain when collateral dies. Bankruptcy follows. Credit is destroyed. Recovery becomes not a strategy, but a decade-long sentence. And yet, every crash makes someone rich. In 1929, Joseph Kennedy became a legend for shorting the market. Bernard Baruch, holding cash and gold, walked into the Depression and purchased assets at prices that would never be seen again. In 2008, John Paulson earned $20 billion betting against subprime mortgages. Michael Burry made $700 million by refusing to believe what everyone else insisted was safe. Warren Buffett bought stakes in banks and corporate icons at fire sale valuations and rode the recovery to billions. The pattern does not change. Those who hold cash, not speculative tokens, not leveraged real estate, not meme stocks, preserve purchasing power. When markets fall 50% or 60%, cash becomes a weapon. The wealthy sell before the crash, accumulate liquidity, then buy when others are panicking. Short sellers profit again. They target the most leveraged sectors: commercial real estate, regional banks, corporations that hid weak balance sheets behind cheap debt. If a financial stock collapses from $50 to $5, the short seller makes $45 per share. It is not luck. It is math. Gold rises when currency is diluted. In the 1930s, Roosevelt revalued it upward, instantly rewarding those who held it. After 2008, gold doubled. When the central bank prints to stabilize the system, the asset that cannot be printed appreciates. Distressed debt buyers strike at the moment of maximum fear. When bankrupt companies trade at 10 to 30 cents on the dollar, vulture funds accumulate their bonds. They wait, restructure, and eventually collect 50 or 100 cents. A $100 million position becomes $300 million. Ikahan, Howard Marks. Oak tree. This is how they built empires. Real estate consolidators repeat the same playbook. After 2008, Blackstone purchased tens of thousands of foreclosed homes at a fraction of their peak value. They rented them out and waited. When the market recovered, they sold. The public lost homes. Private equity gained portfolios. Crashes do not destroy wealth. They transfer it from those who do not see it coming to those who anticipate the cycle. Comparing 1929-2008 and the next major downturn reveals the same mechanics. The bubble forms when asset prices break away from fundamentals. The leverage accumulates. Margin debt in 1929, subprime mortgages in 2008, corporate and government borrowing today. The narrative is constant. This time is different. In 1929, it was the permanently high plateau. In 2008, it was the myth that housing never falls nationwide. In modern cycles, it is the belief that central banks won't allow markets to collapse. Each generation tells itself a comforting lie. Each generation pays for believing it. And every generation produces a small group of people who become unimaginably wealthy. not because they are lucky, but because they understood the pattern while everyone else dismissed it. Those who are fully invested, leveraged, and unprepared are always the ones who suffer most. And that pattern has not changed in over a century. What has changed is scale. In 1929, total U.S. stock market capitalization was roughly $80 billion. By 2008, it had grown to around $12 trillion. By the mid-2020s, it has reached nearly $50 trillion. When valuations grow that large, corrections no longer erase billions. They erase trillions. Losses of 20 trillion or 30 trillion are not theoretical. They are structural outcomes of a globalized market that is 4 times larger than the one that collapsed in 2008. Speed has changed as well. The 1929 crash took years to reach its full depth. The crisis in 2008 took only months. In a world driven by algorithmic trading, instant news diffusion, and interconnected capital flows, market movements accelerate. Sell-offs that once unfolded over quarters can now unfold in days or even hours. A shock anywhere becomes a shock everywhere. Global interconnection itself amplifies the damage. The crash of 1929 was primarily American and only gradually radiated into Europe. The 2008 crisis was global, but some emerging markets recovered quickly because they were not as tangled in Western financial plumbing. The next crisis is different. China, Europe, the United States, and emerging markets are all braided together through debt markets, supply chains, digital payment networks, and multinational asset flows. A collapse in one region is transmitted instantly across all others. There is no isolated safe haven, only relative levels of exposure. Government capacity to respond has also changed. In 1929, policymakers simply did not act, and the system imploded. In 2008, they had space to intervene. Interest rates were high enough to be cut. Fiscal deficits had room to expand, and central bank balance sheets were small enough to absorb stimulus. In the present era, rates have already been near historic lows. National debt sits above 120% of GDP, and central bank balance sheets are already massive. Monetary ammunition still exists, but every shot has diminishing effect. Interventions will likely be larger than those seen before, but they may restore less. The social consequences of crashes, however, remain consistent. When the middle class is damaged, political systems destabilize. The crash of 1929 produced extremism, authoritarian movements, and radical ideology. The crash of 2008 produced popular revolts, distrust of institutions, and widening polarization. With wealth inequality far higher now than in either era, the consequences of another major collapse could be more intense. Many households already feel economically precarious. If the shock wipes out what remains of their savings, the reaction could be not simply protest, but structural upheaval. The timeline is not a prediction of exact days or months, but a pattern-based projection. During the early to mid phase of the cycle, markets sit at record highs. Valuations stretch far beyond fundamentals, and leverage quietly builds. Investors convince themselves that central banks will prevent large crashes because they have done so before. Then some triggering event occurs. Perhaps a cluster of bank failures, a large corporate bankruptcy, or a geopolitical shock. Markets fall 10 to 15%, and the narrative shifts from euphoria to unease. This is the first phase, the initial shock. Soon after, prices appear to stabilize. Analysts declare the worst is over, and investors buy the dip. This is the false recovery, a deceptive calm when problems are spreading beneath the surface. Next comes the cascade. Defaults accelerate, credit tightens, liquidity dries up, and selling feeds on itself. Markets can fall 40% or 50% in a matter of months. This is not emotional panic. It is mechanical. Margin calls, risk models, and institutional mandates force liquidation at the worst possible time. As the downturn intensifies, unemployment rises, banks fail, and confidence collapses. Eventually, the panic bottom forms, often at the moment when despair feels absolute. That is when governments intervene. Aggressively. Central banks cut rates, fiscal packages are passed, and liquidity returns. Only after that shock absorption does the slow recovery begin. Markets stabilize, then gradually climb. The economy heals, but it does so at a human pace, not a trader's pace, and it may take years before asset prices return to their previous peaks. The sequence can compress or stretch, but the order rarely changes. The pattern has repeated twice in modern memory, and both times it delivered the same lesson. Individuals who treat markets as invincible are the ones who lose the most. The strategies for navigating such cycles are not complicated, but they require discipline. Reducing exposure when valuations are extreme protects capital. Holding a portion of assets in conservative instruments preserves purchasing power when others are forced to sell. Keeping a small allocation to gold or other non-printable assets can help when monetary policy dilutes currency. Identifying fundamentally strong firms with durable earnings, low debt, and essential products, and waiting to buy them at steep discounts has created fortunes in every downturn. None of these steps are dramatic. What is difficult is having the emotional resilience to act when fear dominates the news, and every headline screams collapse. The most underestimated preparation is psychological. In March 2009, buying stocks felt insane. In the early 1930s, buying assets felt suicidal. Yet those who did are remembered as visionaries. The difference between losing everything and emerging stronger is rarely the model or the analysis. It is the willingness to execute while others hesitate. Protecting income matters as well. Crashes bring layoffs, frozen hiring, and wage stagnation. Cutting debt, building emergency savings, and strengthening your value at work can be the difference between surviving the downturn and being consumed by it. Watching indicators in real time. Commercial real estate defaults. Regional bank stress, high yield spreads can help identify when the third phase is approaching. These are warning lights on the dashboard. When they flash, caution is not paranoia, but prudence. There is always the possibility of a soft landing. Perhaps central banks manage to unwind leverage gently. Perhaps markets normalize through time instead of trauma. But history suggests that when valuations, debt, and complacency align, the result is not orderly. Crashes are not random meteor strikes. They are the natural resolution of imbalances. They destroy the unprepared and enrich those who understood the cycle. The bubble forms, the leverage accumulates. Optimism becomes universal, and everyone convinces themselves that this time is different. When the trigger finally arrives, the pattern unfolds the same way. Some people will lose homes, savings, and businesses. Others will emerge far wealthier, not because of unfairness, but because they positioned themselves when the warning signs were visible. You do not control when the cycle turns, but you do control how you respond to it. You can ignore the rhythm of history and hope that momentum never reverses, or you can recognize the pattern, protect your downside, and prepare to act when fear suffocates the market. Crashes have always transferred wealth not by magic, not by conspiracy, but by timing and preparation. History is unambiguous. Those who understand the pattern survive and even profit. Those who dismiss it learn too late. The conditions are in place. The cycle is mature, and the next turn will arrive as it always has. What you choose to do with that knowledge determines which side of the transfer you stand on.